Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, March 27th, just after the close. We've been working in the office and remotely. Stopped into the office to shoot the video today, give you some of our thoughts. John Mousseau is going to be on as well. As John said last week, really needed to see a bid return to the fixed income market to try to lend some strength to equities. We did see that. John will go over some of his thoughts, both taxable and munis, and give some color on what he saw throughout the week. Equity-wise, a little air back in the balloon. Monday had that downdraft off the bell, off a tough headline weekend. It was nice to see some demand come in Tuesday through Thursday, and then a pullback today. If you were going to script what was going to happen, and what we know is the market will not follow a script. It never does. What happened today, this pullback, is just fine if we can create a higher bottom versus last Monday. That's something that from a supply and demand standpoint we would like to see. So for most of the week we had a good up week. Difficult to chase that up week with investable dollars. Trading dollars perhaps. Now we got the pullback today. Let's see how that's treated Monday, Tuesday, Wednesday. It can end up being a very strong positive for the market. Market's very fast. Bid offers are fairly thin. You're seeing a lot of whip to the markets day to day. Thursday, Dow went from up 700 to up 1,300 in 15 minutes. Today, around, call it 330, 340, Dow was only off 175, 200 points. Gets hit with a sell order, gets hit with the machines, which can take over from time to time, end up down over 900. Not a catastrophe, a pullback off of that initial burst off of Monday's numbers. Which brings me to something that I wanted to discuss in terms of managing your money and what we try to do here. When markets are fast, and when I say that, I should define what I mean. Fast markets are illiquid markets that can move 1%, 2%, 3% in an hour. Those are what we call fast markets. Those type of markets, as an investor, you actually want to slow down. Fast markets should force you to slow down, or you're chasing both up and down. As you slow down and create areas that you find value, or we find value, let the market come to you in a fast market. This is how you had to treat the markets in 08, 09. I cannot tell you how many times traders and investors took a rally and thought that was the end of the nasty downtrend. And we got multiple 12, 15, 18, 20% moves in the space of, let's call it spring of 08, all the way through March of 09. What happens is those fast moves wear you out. They exhaust you as a trader. They exhaust you as an investor. Don't get caught up in these fast moves. Make the market prove that it has some staying power. So if you do have cash on the sidelines in a strategy, you don't have to chase every rip here. Let the market prove to you that there's demand under it. That's what we're going to find out next week. We're going to find out if today's drawdown, which may continue early next week, can be met with demand at a higher level than Monday's lows. And that can be very constructive. But let's not get ahead of ourselves. I'm finding people very emotional. They're letting the market dictate their emotions. It's very difficult to get away from that. That is normal. Don't ever beat yourself up for that. We fight it every day. Don't beat yourself up for a poor trade here or there. In nasty markets, you're going to have regrets on different trades. Just have a plan for the trade. Some of the trades will be you sold and the security went higher. You've got to step back. Don't beat yourself up on that. Something I learned early, and it was back in 01, when people were really getting down, don't forget, the emotional part of what's going on here with this virus is somewhat similar to '01 with that emotional, crushing emotional feel of 9/11. And poor trades would tend to trigger negative emotions where you get down on yourself. Don't get down on yourself. Keep just chugging along, making intelligent, reasonable decisions. That's what we're trying to do on our end. We have some strategies that remain fully invested and rotate amongst sectors. We have others that raise cash in those areas where we have a bucket of cash. We'll be looking for levels. And then we have balanced accounts where we're playing off of the equities with cash and bonds. Those allocations are what are going to get you through this period, as long as you don't allow panic and emotions to start making the decisions for you. So let's see what next week brings. You're going to get some great information out of the Moose. He'll be on right after, and we will speak next week. If we are in the office, we'll try to do a midweek video as well. Have a nice weekend. Stay safe.
Hi, I'm John Mousseau. I'm the President and CEO of Cumberland Advisors and Director of Fixed Income. And it's Friday, March 27th. See, my colleague Matt and I both have the virus beards going. They will be coming off when the virus scare is all over. Maybe we'll raise some money for charity. A little bit about bonds. We weren't on in midweek, but if you remember a week ago, I was telling you how much distended bonds other than treasuries were. High-grade corporates, tax-free bonds, junk bonds, totally distorted. What did we have this week? Well, we had a heck of a week in bonds that were non-treasuries. Treasuries moved a little bit. The 10-year's gone this week from 0.85 to 0.65. The 30-year bond went from 142 to 124, so not much movement. The real story, the stimulus bill that got passed, it has aid for corporate bonds and municipal bonds. Has the Fed acting as an agent for the Treasury, able to buy investment-grade bonds inside of 5 years in both those classes. Whether they will or not, we'll see. Just the news that they can sent yields on these other asset classes lower. And I mean lower a lot. So bonds that were trading in the muni land at 4 to 4.5% are now down closer to 3%. That is a dramatic change. Bonds down the curve that were trading at 3% in like 3 or 4 years are now trading at 1.5 to 2%. Dramatic change. Are we back all the way to where we were? No. Are municipal bonds still cheap to treasuries? Yes, by a lot. I mean, all you have to do is think about a 30-year bond in treasuries at a 124 and think about a lot of municipal bonds still at around a 3. 3 is a lot bit different than 4.5, but it's still very cheap on a relative basis. We think the real story this past week was the fact that the Fed helped the money market funds, both taxable and tax-free. We know that by making sure that they were operating, then you moved out further on the curve with what happened with the stimulus bill. That got the bond market functioning again. The functioning bond market was a big reason, as Matt explained, why equities were up. So as we go forward, we expect bonds to continue to do okay in here. And now that you've taken the worst part of it off, and on taxables, that means corporate bonds that were trading at 350 basis points in spread got down to about 150 basis points in spread. So the real runaway turned right around and ran back. And you can thank the Federal Reserve for most of that. We'll try to keep you informed next week as we go forward, but the idea that we've returned to some degree of normalcy is very, very satisfactory as we go into the weekend. So we'll see you next week, and our beards will be a little longer. Thanks a lot.